Joining me now from Cape Town for our weekly strategy session is Asief Mohamed, who's Chief Investment Officer at Aeon Investment Management. Hi, Asief.
Hi.
We have a slight delay there, but we've got communication. Asief, we've been talking a little bit this morning about signs of recovery in the United States, and I have a report from Franklin Templeton which points to some of those indicators, which we can get onto in a moment. Of course, news this morning about the Spanish banks separating toxic debt from their other books and numbers, and possibly a surprise coming there, negative surprise according to Mike Hayworth, who we spoke to earlier. And of course Europe's still uncertain, and then issues around Chinese demand. Those are the things that have been swirling around. So you have to take a strategic view. It is a strategic session. Let's move up a bit and say what your bird's eye view, if you like, of the markets at the moment, the equity markets.
The equity markets at the moment, our view is as I would say, it's quite a boring view in the sense that markets in brief is, especially US markets and South African markets, is what I would say is close to fair value. It's not excessively expensive or excessively cheap, and probably fair value is probably the way to describe it. If you look at the US equity market, it's sitting on a forward multiple of 14 times. If you look at long-term historic averages for the US market, it's about 15 times on average. So from that perspective, I think the market is at fair levels. However, what we need to do, and some people would say, especially the sell side strategists specifically, they would say that the market is cheap based on US earnings yields relative to very low bond yields. Earnings yields is about 7% in the US, equity earnings yields. The bond market is in a 2% yield, so based on that, it appears to be cheap. However, I need to caution, if you look at Japan, that gap is even wider and it's been cheap, and that market hasn't really performed. But be that as it may, you know, bull markets, there's a lot of worries about out there. You've mentioned a number of them. You've mentioned Spain and possibly Italy. You've mentioned probably the US possibly slowing down. The economic growth has been improving at a slow pace. Nevertheless, China, you're talking about China risks where China might slow down further. The implication for that is the resources prices might fall down there, might fall, and put a lot of pressure on South African company earnings, because our market has got a lot of resource companies in it. So there are a lot of risks out there, but just bear in mind that bull markets are built on a wall of worry, and there's a lot of worry out there. So the US market, and it's been out there for some time now, since about for a couple of years now, and since about the middle of September last year, the US markets have performed really well. It's not going to perform as well going forward, but I wouldn't necessarily not be exposed to equity markets. In fact, I'd be overweight relative to a benchmark, to a neutral benchmark when it comes to equity markets. So yeah, on the whole, you know, lots of risks. I can give you more risks out there, but I would say that the market is at fair value to the current moment in time.
You've made the point that profit margins in the United States and South Africa are high in contrast to Europe.
Yes, that is another risk out there. Profit margins at close to record highs. What could potentially happen is that, you know, once the competition starts seeing that the margins are excessively high, that would come in. The counter to that is that what's happening is that if you look at both US growth and, let's say, Chinese growth, it's sitting at, US growth is close to 2%, Chinese growth is sitting at about 8% or so. What's happened in the Chinese market, although it's had very good economic growth for the last number of years, the competition there has been so big because everybody's seeing this good growth coming through, and margins has been really low, and it's very competitive. So the Chinese equity market has in fact not performed. In fact, it's underperformed for a number of years. So however, if you look at the US market now, currently people are seeing low economic growth. Why should they be going there? So the level of competition isn't that high, and the existing companies there aren't, you know, their margins aren't being squeezed. So if you see that view from corporate still carrying on for the next couple of years, we shouldn't be surprised if the US equity market perform relatively well, apart from the fact that, you know, the US equity market isn't that expensive relative to its history.
Of course, there's something else.
The other factor that we need to take into account in the US market is the question of baby boomers. and they're starting to retire now. And if you look at the percentage of baby boom, the working population of between 50 and 60 years relative to the working population between 40 and 50 years, what you see is that that ratio is starting to increase. And what that tends to indicate is that PE multiples in the US should be coming down. So it might not stay at the 14 multiple, it will come down. So that also might be a headwind going forward for US equity markets. But nevertheless, I still believe that the competition and margins are important. I don't think the competition will come into the US in a big way, so it should be supportive of equity markets, both in US and in South Africa.
Asief, I just picked up a Franklin Templeton report this morning from their fixed income division. They talk about a gradual improvement in the US economy, and they say that the jobs picture must brighten. And they've got a couple of interesting graphs in the report where they talk about the median prices of US houses, those are existing home sales, and the median price, in other words, not the average, it's the price in the middle of the range. And that price has gone down from 225,000 average in 2006 to just over 150,000 now. And of course, one doesn't want to say that an up is inevitable because that's how the graph looks, but it does look as if a base may have been reached there. And then the other number they talk about, it's a projection rather than a reality, and it might just be wishful, but they certainly look like managing the deficit down to about 3% by 2016.
On the question of the house prices, the reason why it's come down such a lot, as we all know, is because it was in a price bubble without a doubt, and history has now proved it, and it's come down significantly. The question is really whether it's come to levels whether it's affordable. Don't be surprised if markets tend to overshoot on the underside also, so you might see a little bit more pressure on house prices, but it's come down significantly. However, my view is with the low interest rates of the Fed, it's really encouraging people to take risk out there. You're earning absolutely nothing on your money market funds as such. So you're forced to go and look for additional returns, and that's where people are being forced to, is the equity market, where the dividend yield might be a bit higher, where you get hardly anything on your money market or your bond on bonds in real terms. So my sense of it going forward is that the US house prices is probably starting to bottom, and I wouldn't be surprised if it probably stay flat, and that's also good for equity markets because it's creating some sort of stability. If interest rates stay longer also, and the Fed has signaled that that's the case for longer for some time now, that will also create some stability. Stability is actually very good for markets. So if we've got a stable environment, I think also that will be supportive of equity markets. However, what might happen because of the excessive printing of money in the US markets, we should look out for inflation down the line. I can't say when, but you're probably looking for a year or 2 years down the line. Once you see inflation rearing its head, then you know that the Fed will have to increase interest rates, and that would be the signal that equity markets is possibly not going to give the returns that it's going to give you. However, if you have excessive inflation, very high inflation, in equity markets might be a good place to be in because they would be able to pass on those price increases and with the prospect of higher profits, and that should act as a hedge against inflation.
Of course, you mentioned the interest rates there, and they've also promised that they will stay low. We don't have anything like that. They've promised them for a couple of years. Let's move to the South African environment where our interest rates look huge compared to those in the United States. And any particular sectors in the South African market, if you could reduce your strategic view to a more tactical one, if you like, sectors that are of interest at the moment to finish off?
Yeah. The one sector that I broadly like is resources because it's on low price earnings multiple. But the one that stands out at the moment, and specifically it's the telecom sector, more specifically MTN and Telkom. MTN has come down a lot because of the Iranian situation. However, the dividend yield on a 2 to 3 year basis forward at current prices, if they increase the PI ratio, and they will because they're generating lots of excess cash, we'll take it close to the 10% level. That's in about 2 or 3 years' time, not now. And that's good, from good return to get from a dividend yield perspective. The other one is Telkom. It's been such an absolute dog in terms of performer. It's underperformed for many years. Its earnings has been decimated. It's overpaid for acquisitions. It's really messed. The company has really been in a bad shape. However, at current levels of 23 Rand, just under 23 Rand, it's starting to offer value. It might be a value trap. In fact, it has been a value trap. With SK Telecoms from Korea potentially coming in, and if they come in for, let's say, a 25% stake at much lower prices than it was indicated in the press, I think Telkom could potentially be a position for a turnaround. Not a significant turnaround, but it could offer an opportunity for returns of about, possibly for the next 6 months to a year, of about 20% plus. But you've got to buy it at lower levels, at these low levels, if you get into Telkom. It's not without risk, but it's an opportunity that's out there that one should look at.
Well, we'll have to stop there. Thanks to Asief Mohamed, CEO at Aeon Investment Management.